Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for another volatile session here on the 27th of September, 2022. We have new lows on the year on the equity markets. The big headline news is going to be that the S&P, the SPX, right behind it, is the SPY right here, SPY. That's your ETF that made new lows. And behind that, or already before that, the contract adjusted ES futures did precede those with new lows. Now, Nasdaq is not quite there. Dow mini futures, DIA, which is a tradable ETF, and of course the Dow Jones Index itself, that has broken lows before. That was the first index to do so. And the Russell, not quite there, right there with the Nasdaq. So you may be hearing on the headline news tonight that the S&P did make new 52-week lows, or they'll put it, new lows on the year. I'm sure they'll find a way to make that headline more appealing. But nonetheless, truth of the matter is that the downtrend continues as economic conditions worsen. Inflation, of course, continues to be on top of our mind and top of the market. So that still is the play. We'll talk about risk reversals, but first let's jump into the inflation train, or the inflation play. So as inflation continues to be a relatively large concern for the market, interest rates, this is the 10-year Treasury note yield. We can look at smaller or lower time frame, the 2-year, the 1-year, etc., or the 30-year bond. That's actually making new highs, but that's been the trend. So we are accelerating the trend, something that was last seen earlier in 2022, when it's just a vertical move without stopping and without retracing. Now, the risk of retracement's high. The higher, faster, harder the market rallies, that puts a little bit higher probability of a reversal. So we are going to be on guard going forward into September here at the end of it to October of this particular scenario, which is not a reversal, not a trend reversal, but just a risk reversal, or as I would call a normal pullback against a strong prevailing trend. That will also be true in the TLT, which is the bond market, and that's pulled off to new lows. TLT is a tradable ETF for an approximation of the 10-year Treasury note bond. A Treasury note, the bond, the 30-year bond, that's pushing new lows as well. And they're accelerating. But again, we'll draw our attention to earlier in the year, similar to April into May, where we did have acceleration in the downside. We'll zoom in on those. But it did get volatile. And what we're asking now, what are the odds of continued drop to the downside versus the odds of a risk reversal? And that, again, is just a market that rallies as opposed to keep going down. That's going to be true in the equity market. Again, probabilities. The probability back at the other spot earlier in the year, as I've been discussing in evening videos, was that we saw a similar outcome, which the market went off to make new lows. And the reward pathway was down to make new lows with the risk pathway of a break above. That is complete. That is finished. Now, what is the risk going forward? The risk going forward is for additional downside action. Could it happen? Absolutely. Has it happened before? 100%. And a similar type logic would be earlier in 2022 when the market had 4 or 5 sell days in a row. Are we going to have that again? We've had plenty of sell days in a row, but what are the odds of that? The odds are less favorable, and the reward is a little less enticing. So it could be a whole move down to 3600 in the S&P. That is a key level I've had drawn out for many, many weeks here, and that's been on the weekly charts, is simply the 2020 highs, or a last spot where the market paused. So that's going to be a key level, 35, almost 3600 in the big picture. Might we get there? The odds of that are very high, but the reward of that occurring is just not worth the risk of what we might consider a strong bounce or a strong rally. The time to short markets, or to be bearish or to play put positions, is not at new lows, but on bounces after a retracement or after the market has traded higher. that's a good time to put on risk to the downside, not when the market's making new lows. That logic would also stay true in the bond market. And if we continue that thought forward about how interest rates in the bond market at new lows, interest rates at new highs, is pushing the dollar index to extend its rally and extend its uptrend. The trades are those pullbacks. They are to get long or to buy on the pullbacks or retracements to rising averages, perhaps rising trend lines, or if you want to be a little more precise, you can add in linear regression lines. I'll just add the 100 and the 50, and we'll take everything else off. And you can see how that would give a good reference point for buys or vertical spreads or call options to join the uptrend and to take profits when the market gets into this upper bound or upper linear regression trend line. That's where we are now. What's the risk of it continuing? Or what's the reward, I should say? The reward is not great. If the dollar keeps going up a few more days in a row, that will be some upside potential. And if you go long right here, you will profit from that. But is that worth the risk of what happened earlier when the market was overextended? Not a trend reversal, but just a pullback, a risk reversal. So the risk is going to be above, and we'll put the risk is above, and the reward is to the downside. And we'll put that same logic again back into the TLT, where the reward is going to be coming on the pops or the rallies, and those profits are taken off at the lows. A little risky at this point, and the same will be true, of course, for the equity market. That's the general thought process as we push from September into October. We had risk of a continued upside rally versus the reward of a retest of the low. And the retest of the low did occur. But that's complete. And those trades are profitable, taken off into profit territory as opposed to rushing out right here, right now, as the market makes new lows and letting that be the proof of the market's in a downtrend. When the market makes new lows, that's not a good time to go in with some new short bearish positions. So the time now is for protection, for safety. And we do have lots of headline news, volatility, and intraday range. So if we go outside of this, we can look again at a market I don't look at, the VIX, as much as you or other traders might. But the VIX Volatility Index is up in the 34. And as the market is making new lows, the VIX is not making new highs for 2022, not yet at least. And that could argue for additional selling if we see this spike to a higher level. So that's something to be continually watching alongside the equity market making lower lows. Remember, the VIX is not keeping pace with that, not at the moment at least. A quick note at gold sees that it is breaking down as well. And then crude oil is also holding a breakdown zone. That breakdown was under 89 or 88, and that is pushing the index or the oil futures, and that's per barrel, down to 78, 76, and a level not seen. In fact, that was a target level not seen since the end of 2021. And we like to look at, especially at the end of the videos, which stocks led the market to new lows. This is which stocks are on the sell side, the downside, the bear side, and they are making lows ahead of the market. The market's made new lows, the market being the S&P. And the stocks that joined the S&P today, there were 146 of them. They included, by order or sorted by market cap, Microsoft, another new 52-week low. Google, now one stock joins, it's a financial company, Berkshire Hathaway. Behind that is Visa. And then Facebook continues making its lows, but another financial company, JP Morgan Chase, MasterCard, and the other names, Nike. Now, Nike's going to be interesting because it does have earnings a little bit later this week. So Nike will be in focus, whether it is a bounce candidate, and we'll see it here, or whether it makes additional new lows into 2022. And a quick chart note on those. Here is Microsoft at its new lows. Again, the reward pathway is for bear positions, and the risk pathway was for a break. Same as the broader equity market. Now, given that Microsoft is making new lows, what are the odds that it keeps making new lows versus a reverse risk rally? So that's what we'll watch for in the next few sessions. If you are an ambitious trader, an aggressive trader, one who does want to capture some of the potential bounce, that would favor the bounce or the long side, but this does have the chance to continue extending lower. It just means that risk is high, and we'll continue to be careful in our positions. There is Google off at its lows. Berkshire Hathaway joins a list of new 52-week lows. Visa extends the lows, as does Meta or Facebook. JP Morgan Chase extends its lows as well, as does MasterCard and other stocks. We can see if you want to run the scan, it would just be a load scan query, go to the public, and then go into new yearly lows. Scan in the S&P 500, and you'll have the same list. You can scan in any other market or index that you would like, including a custom list. But what this shows is stocks leading the market to lows, and they could keep pushing lows. They will not go down forever, but they will, or they have at the moment, again, pushed those lows. And that same conversation happened each time the market made new lows. These stocks made that list, and stocks making 52-week lows have better odds in the future to keep making new lows, setting up bear positions on retracements or risk reversals or a pullback to a higher level. We'll be watching these closely in a news-filled, volatility-filled week. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video update for September 27th, 2022.